Hello everyone. In this review exercise, we are going to book some journal entries for Showtime Sports Therapy. In our first entry on January 1st, Showtime Sports Therapy's owner is going to contribute $150,000 worth of equipment and $100,000 worth of cash to the business. Well, what accounts is this going to affect? The first one is going to be cash. The second one is the other thing the owner is contributing, which is equipment. And when an owner contributes to a business, what does he or she receive in exchange? They receive equity in the business because they're giving up their own personal stuff to grow the worth of the business. Therefore, their stake in the business has to be increasing. And we're going to book that under our owner's capital account. What types of accounts are these? Well, cash and equipment are both assets they're thinking business is going to use to turn a profit in the future, while owner's capital is an equity account. Cash is an asset. Is it going up? We're talking about the business's cash here, and if the owner's taking money out of his personal funds and putting it into the business, then the amount of cash the business has to be increasing. And by that same rationale, the amount of equipment the business has is also increasing. Again, owner's capital is an owner's stake in the business. If this person is giving up $250,000 worth of their own stuff to put it into the business, their stake in that business better be going up, and it is. So equity is increasing here. So the first account that we have is cash, our asset account, and it is increasing. And like all asset accounts, it's going to increase with a debit and decrease with a credit. So we debit cash. Equipment, also an asset, also increasing. Going to also be a debit. And then equity, capital is an equity account, and all equity accounts increase on the credit side. So the journal entry here is going to be on January 1st. We're going to debit cash for the amount of the contribution, which was $150,000. We're going to debit equipment for that same amount, which was $100,000. And then lastly, we're going to give this owner capital equal to the amount he contributed, which was $250,000. That gets credited in this entry to record an owner contribution. In our next entry on January 1st, the company is going to prepay $4,800 for 6 months rent. So they're prepaying the rent ahead of time for the months of January through June. Well, what accounts are being affected here? The first one is going to be prepaid rent. And the second one, if we're paying ahead of time, what are we giving up? Cash. Prepaid rent, like all prepaid accounts, are assets. They're things that are going to help your business in the future because we have already paid a ton of rent ahead of time. Cash, also an asset. Prepaid rent on our books is the amount of prepayment we have sitting around which has not been used up yet, which means this, since we prepaid for more, has to be going up while our cash would be going down. Their assets, they go up with a debit, down with a credit, so prepaid rent is going to be debited and cash is going to be credited. And on January 1st, we're going to debit prepaid rent for $4,800. We're going to credit cash for that same amount in the journal entry to record the prepayment of 6 months rent. In our next entry, Showtime Sports Therapy is going to perform $500 worth of cash services for a customer named Paul Chris. Question to ask yourself with these is, what are we doing to earn revenue and how are we being paid for it? Well, their cash services means we're being paid in cash. And I said we're earning revenue. What are we doing to get that revenue? We're providing a service. So service revenue is going to be our other account. Cash is an asset account. Service revenue is a revenue account. Are they increasing or decreasing? So cash is an asset. We're getting paid by this customer, Paul Chris. Our cash has to be going up. Revenue accounts track how much work we did over the period. Well, we just perform more services. That has to be going up. Assets go up with a debit, and revenue accounts work the opposite way of assets, which means they go down with a debit and up with a credit. So our journal entry on January 8th is a debit to cash for that $500 and a credit to service revenue for the same amount when we reported the entry to record the fact that we performed cash services. On January 9th, we performed $1,500 worth of services for another customer named James Harding. This time, they're being performed on account, which means we're not getting paid at the time we perform the services. We're billing them, but they owe us the money. And in accounting, when someone owes you money for something that is typical of your business, like providing services, you record it under accounts receivable, or AR, if you will. But you still get to record the revenue at the time you perform the services, even though you haven't received the cash yet. So our two accounts are accounts receivable and service revenue. Accounts receivable is something that's going to be converted to cash later, therefore it is an asset. Service revenue is a revenue account. The amount of money owed to our company is going to increase after we perform these services and bill Mr. Harding. And the amount of revenues that we've actually earned during the period is also going to go up because we did the job. Which means our asset account going up is going to go up with a debit, and our revenue account going up is going to go up with a credit. And on January 9th, we're going to debit accounts receivable for $1,500. We're going to credit service revenue for that same amount when we record the entry for performing these services on account. On January 15th, we received $1,000 from James Harding for services performed on January 9th. So Mr. Harding is paying a portion of the balance he owes us off. And since he's paying us, one of the accounts that has to be affected is cash. What other account is going to be affected? Well, he doesn't owe us as much money anymore, which means we can't have his receivable on the books for the same balance that we had before. So our credit, in this case, is going to be to accounts receivable. What type of accounts are they? They're both assets. The amount of cash the business has is going to be going up, while the amount of money owed to the business, our receivables, are going to be going down because he's paying off his debt, and all assets go up with a debit and down with a credit. So on January 15th, we're going to book this as a debit to cash for the amount of payment, which was $1,000, and we're going to credit accounts receivable for that same $1,000 in our entry to record the fact that we collected on a customer's account owed to us. On January 18th, we purchased $10,000 worth of tables and chairs for the waiting room, and we did so in cash. So what are we buying? How are we paying for it? We're buying tables and chairs. Let's put that down under furniture. How are we paying for it? We're paying with cash. So those are our two accounts that are going to be affected. What types of accounts are these going to be? Well, furniture is something that our business needs in order to generate revenue in the future. It's going to be an asset. Cash, also an asset. The amount of furniture our business owns is going to go up after we make this transaction, while the amount of cash that we have, since we're paying in cash, is going to go down. So since they're both assets, and assets go up with a debit and down with a credit, furniture is our debit and cash is our credit. And we record the journal entry on January 18th as such: debit to furniture for $10,000, credit to cash for the same amount, and we recorded the cash purchase of furniture. Next up, on January 29th, Showtime Sports Therapy is going to pay $300 cash for its electric bill and $900 cash for its employee salaries. What accounts are being affected? What are we paying for? We're paying for our utilities, our electric bill. We're paying our employees for the amount of money we owe them because they worked for us. Those are normal things in the course of business. And when you pay for something that's typical of your business, that you're going to pay for period after period after period, you record them as expenses. So let's call that utilities expense and salaries expense. How are we paying for both of these? We're paying in the form of cash. What are our account types? Well, utilities expense and salaries expense both end in the word expense, so let's call those expenses. And cash is an asset. Expense accounts track how much you paid for any one particular thing over a period of time. So maybe we're tracking for a month, maybe we're tracking for a year. It doesn't matter, because after we pay both of these, we have paid more in total for these expenses during the period. So utilities expense and salaries expense are both going to increase, while our cash is going to decrease because we're paying a bill. Expenses work just like assets. They go up with a debit, down with a credit. Since they're both going up, we're going to debit both expense accounts, and we're going to credit cash because there's an asset decreasing on January 29th when we record this journal entry. And for this entry, we're going to use the description that we paid for these expenses in cash. On January 30th, we purchased $1,800 worth of office supplies, and we did so on account. Well, what are we buying and how are we paying for it? We're buying supplies. How are we paying for it? We're not. We purchased it but we're not paying at the time of purchase. We're going to be sent a bill that we have to pay later, which means we owe something. And that something we owe, since it's typical of our business, is going to be recorded under accounts payable. Supplies is an asset account. Accounts payable means we owe someone else outside of our business money, which means it's going to be a liability. The amount of supplies our company owns after we make this purchase is going to be going up, and the amount of money we owe to other people is also going to be increasing because we just took on more debt by buying these supplies on credit, if you will. So supplies as an asset is increasing, and assets, as we've seen before, increase with a debit. Liabilities decrease with a debit and increase with a credit, and since this one is increasing, we're going to credit accounts payable in our January 30th entry, where we record the purchase of supplies on account. On January 31st, Showtime Sports Therapy's owner withdrew $400 from the business for his own personal use. So their owner wants to buy something that's not a business asset. It's for his own personal use. He can't put it on the business's books because it doesn't benefit the business in any way. So what does he have to do? He has to first formally withdraw this money, and he's going to do so in his owner's withdrawals account. One thing being affected: if he's taking money out of the business, what other account's going to be affected? The amount of cash the business has. Owner's withdrawals are withdrawal accounts. Cash is an asset. Owner withdrawal tracks how much money an owner has taken out of the business over a period of time. Well, he just took out more money, so that has to be going up. And our cash, since it's coming out of the business, has to be going down. Withdrawal accounts work just like assets. They go up with a debit, down with a credit, which means in this case, since this is going up, we're going to debit our owner's withdrawals account. And since cash is decreasing, we're going to credit cash. And on January 31st, we start our journal entry with a debit to owner's withdrawals for the amount that the owner withdrew, which was $400. We credit cash for that same amount, and we record an owner withdrawal